November 5th. From yesterday into today, financial markets worldwide have seen a broad-based decline across nearly all asset classes. This is what we call a systemic sell-off, which is different from the risk-off downturns we've seen before. Worried that everyone might panic, I got up early to make this video. Original content isn't easy to produce, so if you find it helpful, please give me a follow and a like. Thank you. Last night, virtually every investable asset experienced a wave of systemic panic reminiscent of the days when the trade king announced reciprocal tariffs. The sell-off began yesterday morning in Asian markets, with Japan and South Korea falling. South Korea saw particularly steep losses. By the afternoon, European markets followed, and by the evening, all three major US indices were in the red. The Nasdaq dropped over 2%, a notable decline by recent standards. Chinese stocks listed in the US fell by a similar margin. The key takeaway, however, is that even traditional safe haven assets like gold and silver fell. Silver dropped more than 2%. This confirms this was a systemic, across-the-board decline. Let me share my perspective. This drop is normal. In fact, the real worry would be if markets never corrected. The previous rally had gone a bit too far, too fast, so a pullback was due. Even with yesterday's 2% drop, the Nasdaq is still up 21% year-to-date, and the S&P 500 is up 15%. These gains are quite substantial, especially considering the backdrop of reciprocal tariffs. I've consistently held three core investment principles. Respect the market. Never forget that US stocks can fall sharply too. Bull runs are only one part of the market cycle. Downturns are a good thing, they keep the market healthy. A pullback is a cooling off, not a collapse. Don't confuse long-term strategy with short-term trading. Some investors, including members of my community, often end up turning their investments into day trades. This mindset breeds panic the moment the market dips. If you're feeling nervous, just take a look at the yearly chart for the Nasdaq and the S&P 500. You'll see that this decline is actually quite minor in the grand scheme. For long-term investing, focus on fundamentals. As long as the fundamentals are sound, your position should be rock solid. Ask yourself two questions. First, have the core fundamentals of the US economy changed? Second, has the earnings potential of the major tech companies been impacted? Many people were complaining just days ago that the market never gave them a chance to get on the bus or buy the dip, fretting about what to do while it kept rising. Now, at the first sign of a drop, they panic. This kind of reaction isn't helpful. Yesterday's decline was primarily driven by two factors. The US government shutdown. The US is potentially facing its longest government shutdown in history. The previous record, also during the Trade King's first term, lasted about 35 days. This one is expected to exceed that. I've previously analyzed that a prolonged shutdown could negatively impact both the US economy and the stock market. Given the Trade King's current stance unlikely to back down without gaining something, this issue is set to continue festering. Warnings from Wall Street. CEOs of major investment banks like Goldman Sachs and Morgan Stanley issued warnings yesterday, stating that US stock valuations are somewhat high and a correction of up to 10% is possible. This was compounded by a prominent short seller announcing they had begun shorting Nvidia, further fueling market anxiety. This triggered a wave of selling across the board, which defined yesterday's market sentiment. In reality, this kind of behavior and these sentiment-driven sell-offs occur periodically in the US stock market. They represent a form of self-adjustment and are beneficial for the market's long-term health. Personally, I believe if your strategy is medium to long-term, you should welcome this. If the market had continued its previous breakneck pace, any eventual correction would carry much greater risk. For now, let's observe the situation. If declines continue, opportunities to buy the dip will emerge. Chinese stocks listed in the US also fell yesterday by over 2%, and the mainland Chinese market saw corresponding adjustments. The market attributes this mainly to three factors. The recently released PMI data was less than stellar, with the official manufacturing figure hitting a yearly low of 49. New orders also showed some contraction. New regulations for mutual funds, and some hedge funds even halting new investments, could dampen buying power in the market. The general negative sentiment from the broader Asian market decline, Japan, South Korea, also impacted the Chinese market. My view is that the weak economic data, combined with the poor overall sentiment in global markets yesterday, led to the over 2% drop in US-listed Chinese stocks. Finally, a word on precious metals. Gold corrected to $1,930. Note, original text said $3,930, assumed typo for gold price per ounce, and silver fell over 2%. My stance remains, no rush. The correction isn't over, and better opportunities lie ahead. The main reason for the drop in precious metals is that their inherent adjustment cycle hasn't completed. A cold front doesn't last just one day. Let the chilly winds blow a while longer. Let it ge good and cold, so the leaves shake from the trees, creating better opportunities to gather them from the ground. In our members area yesterday, we analyzed the environment for precious metals and pinpointed potential entry points and timing. Regarding silver, we've basically taken all profits. Silver will still have opportunities this year, but it needs to fall thoroughly first. Silver's price elasticity is about 3 times that of gold, so for now, we wait. In summary, this market-wide adjustment is normal. A downturn creates a healthier foundation. Don't panic excessively. Follow us for more. Stay invested, but stay smart.